Hello and welcome to today's edition of Facebook Live. The date is Wednesday, June 20th. It's 3 p.m. Eastern Standard Time. Hello and welcome. I'm Tina Powell and I'm with Mark Germain, CEO of Beacon Wealth Management. Today we are going to talk about SALT, but not the kind of salt that they're thinking about, right?
Not too much salt.
Not the kind of salt you're thinking about. Specifically state and local taxes, and Mark is going to inform us on what that means on the latest deduction. So before we get started, just a real quick word to let you know that this is just general advice. And so you really need to sit down with your own financial advisor or financial professional when speaking about any of these strategies, because they are indeed complex in nature. So with that, Mark, why don't you tell us a little bit about why we are even talking about state and local taxes today?
Well, taxes are real. Everybody has them. And of course, everyone thought that what was being changed with the 2018 tax law was their federal income tax. However, what really changed dramatically was your ability to deduct on what is called the Schedule A of your tax return. So in the past, in 2017, you were able to deduct 100% of your property tax, your local taxes, and 100% of what you paid in state income tax. That's now limited on your tax return to $10,000. So no longer do you get that large deduction. So if you're in a tax state, a state that charges an income tax, that tax bill that you used to pay may no longer be deductible. It has a limit.
And that's big news, right? Because a lot of your clients, they pay, we're living here in New Jersey, right?
Even if they're not, even if you're not our client or a financial advisor's client, you could be paying an enormous amount of property tax and state income tax. So if you're in the six-figure income, you're paying more than $10,000 in property and state income tax already. So the $10,000 maximum number means you're going to lose some of your deductions.
And specifically, these are for taxpayers who itemize their return on their return rather than take the standard deduction. Can you kind of explain a little bit?
Standard deduction in the past was only $7,500. Now, for a single person, it's $12,000, and for a couple, it's $24,000. So it's a huge difference to be able to deduct on a standard basis $24,000 when your maximum SALT deduction is only $10,000. You would have to have charitable contributions or interest on a mortgage in order to get you above the $24,000. Oh, because there's one other thing. You know where if you looked at your tax return and there are those special itemized deductions way down below, those are gone. You don't get to make those deductions anymore. So itemized deductions for many taxpayers are going to go away. If you don't have a mortgage on your home, very real possibility that you're going to take the standard deduction in 2018 rather than itemized.
So you were talking about some of those deductions going out of the way, like give us an example: travel and entertainment,
financial advisor fees,
accountant fees. You go, right?
Accountant fees.
Okay.
Moving.
Right.
Deductions for moving. Your safe deposit box. So you know all of these little deductions that you used to be able to take as special itemized deductions go away.
And a question for you. So taxes, high taxes in a high tax income earning state too. How do the SALT laws kind of differ whether or not that you reside in one of these particular areas? I know that we've got California, Nebraska, New Jersey, New York, Connecticut.
All relatively high states. So there's really, just so people know, the ones who are getting the deductions, and many of the states that don't have state income taxes were complaining to the federal government that because they have a state income tax and people were deducting those off of their income taxes, there was less money coming to them because there was less taxes being paid. 9 states contributed 50% of the total tax deduction for SALT taxes in 2017. It's a huge number. So the states were against it. There's only 9 states that really are making the major contribution. So one of the things that states, and this is what you're getting to, Tina, is states are trying to find ways that your state income tax are still deductible. So make a charitable contribution to your state in exchange for a tax credit, and then deduct that charitable contribution on the 1040 in the itemized deduction section. Be wary. The IRS has not approved or denied. However, if you read the literature, as we have, charitable deductions have to be specific nonprofit organizations. It's very, very specific definition of what charitable contributions can be, and states don't fall into that category.
So if I hear you correct, then so prior to SALT deductions, a homeowner used to be able to deduct the $30,000 in property taxes. Now that's gone to 10, but together with the 10 and possibly, as you talk about it in some states, but not yet approved by the IRS, that this 10 plus this 20,000 charitable deduction could get that homeowner to where they were.
If I were a betting person, I would bet it's not going to be, and that the IRS is going to come out and say you can make all the charitable contributions you want to the state and get a state income tax deduction, so it will reduce your state income tax for the same amount. So if you pay that $20,000 in New York, as Como has suggested, you won't owe the $20,000 of state income tax. Well, that works, okay, because it's the same $20,000, but you're not going to get a $20,000 charitable deduction on your federal taxes. So the out-of-pocket for you has still changed because you're not getting the deduction, hence you're not saving that money on your tax return.
So we have another strategy, and I think a lot of your clients have mentioned this strategy too, that, well, wait, if these are the new laws, and I'm living here in New Jersey or New York or Connecticut and
move on down to Florida, right?
Right. But what about that?
So we really looked at 7 states that have no taxes whatsoever: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. In order to qualify and be a resident of those states and not pay taxes in New Jersey, you must be out of New Jersey or New York or Connecticut 183 days out of the year. And many of these states have even a little bit stricter guideline. Not only do you have to be out of the state, you must establish your residency in that state, change your voter registration, change your license, and one of the things that they're looking at is, where do your loved ones live? And if your loved ones are still living here, they may say, are you really there? Interesting case, and one of our attorney friends told us about it, that this gentleman, very wealthy, was moving between Texas and New York, and he was trying to claim Texas as his residence. And he brought his dog to Texas. Then New York said, he's actually a Texas resident. He has his dog in, he has his dog in
That's
Texas.
very interesting.
So he moved his personal, very, very personal possession to, where do you have the albums from your wedding, and where do you have those things? Those are things that the states actually look at to determine if you're actually a resident in that state.
Very, very interesting.
Yeah.
And then I know that you have one other strategy, which is not meant for everyone, but perhaps that you can shed light a little bit on where non-grantor trusts would have a place in this bypassing this SALT deduction.
So it's important to understand, just for this discussion, there's many more than 2 types of trusts, but for this discussion, we'll talk 2 trusts, a grantor trust and a non-grantor. Grantor trust is, I open a trust and the benefits still come through to me and the assets are still owned by me. That may be a grantor trust. So I'm getting the tax benefits, I'm able to bring that property back into my name. Non-grantor trust, I don't own the assets, I don't get the tax deductions, the trust gets the tax deduction. So if I have a property, I have 3 children, I have a property there's $30,000 in taxes on, I can create a trust that now has
Yeah,
okay?
maybe you can walk us through
I transfer
from one
my
step to
home
another.
into a trust or to multiple trusts. If I have 3 kids, $30,000 in taxes, I can get 3 trusts. Each one of them gets a $10,000 deduction, and I get a $10,000 deduction because the non-grantor trust files its own tax return. A grantor trust does not. Trust is set up for the benefit usually of the children. Trust deducts the property tax up to the $10,000, just like an individual does, but you must have something in the trust that provides enough income to actually pay that expense.
So if the home was in the trust, like you said, and that you rented out the home for a portion of the time, would that satisfy that income?
Right. Now remember, this is generally, we're thinking about this for personal residence.
Exactly.
If you have a second home or a piece of property that you rent out, that already operates on a separate basis.
Okay.
So it already has its own deduction and may deduct more than $10,000 in SALT deductions if it's in a real estate partnership or something special, right? So the trust needs to have its own tax return, and if the property tax is more than $10,000, you may have multiple trusts. Now, pros, cons. The pro is very simple to see. You may actually be able to deduct all of these taxes. What are the cons? You're going to have a separate tax return, which is going to cost you something.
Right.
2, you're going to give up some possession of that asset. And granted, it may be going to your children, but you may not be at an age that you want to give up that potential control.
Right. For some clients, that could be a very emotional decision as well, too.
Yes. And in that giving up possession, you don't lose the right to sell the home.
Okay.
So you always have that right. What do you lose? Is you lose that $500,000 capital gain credit because now it's owned by the trust. You lose the potential for step up in basis when you die, that your kids would get a bigger basis. They're going to live with your cost on the property.
So I think one of the considerations which you're going to talk about also is the fact that, boy, this is really complicated, or it can get very complicated, right? So
there are other considerations. All these things go in. It's not just the SALT tax. There's estate tax, inheritance tax laws in your state of residence. There is multi-state homeowners need already to be mindful of state domicile law, which we talked about in the front, and it varies from state to state. Residency triggered tax audits, which I talked about. I will tell you that chances are very strong you will be audited by your state. If they don't audit you right away, they can audit you in the future when they decide to audit you.
How many years into the future?
Virtually forever.
Oh boy, okay.
So our recommendation is work with an advanced planning firm like Beacon that will run cash flow analysis. We'll do scenario planning. We can put it into our tax planning software so you can actually see what is the cost and what is the benefit. Because in finance, we always tell people to look at, this is my cost, what benefit am I getting for the cost?
And you probably also, too, I would imagine, sit down with multiple family members, because these are some real life issues that you bring up, whether or not that you're going to put your home into a trust, whether or not that you're going to move to another part of the country. These types of decisions, there's the financial, but there's also, too, the life aspect of it.
We had a meeting today with a client, and we were talking about actually, in a couple of years, that they're actually thinking of changing the residency when the husband retires, and their estate is growing. And I said, you really need to bring the family in on the discussion. And we run multiple family meetings per year where we actually have the patriarch and the matriarch and the kids, and we kind of start to talk about what is going to happen and what might happen without, and this is an important thing, you don't have to give all of the information away. So they don't have to tell their kids how much money there is, but this is what we would like to do, and ask the kids what they think is realistic percentages. How would you think the percentages should work? So the kids feel they're involved. 2, they know what's happening, and they actually get to take part in the real family financial discussions and have some concept of what's going to happen in the future.
Well, thank you. This has been a great discussion, and if you have any questions, you can contact the team here at Beacon. Contact Lynette Farina, Lynette, L-I-N-E-T-T-E, at bwmllc.com. She'd be more than happy to make sure that you get in and that you see Mark here and Chris, our next gen planner, and start to kind of discuss these issues. I think on the other fun side, you got a golf event I hear coming up.
Yeah, we have a golf
right?
event coming up for
Okay.
It's generally a client and people that are looking at Beacon, and they can find out about that and getting in touch with Lynette as well.
Good, and there's some information on your website I know about that. And congrats, you were also mentioned in Bloomberg this week as well too.
Yes,
and I know that is going up on your website today as well.
Yeah, we actually talked about that non-grantor trust with the Bloomberg.
Okay.
Yes.
Very interesting. So thanks everybody. We hope that you have a great afternoon, and we will see you back here next month for Facebook Live.
Thank you.